Hi, this screencast is looking at a financial accounting question on ratios, where you're asked to calculate a number of ratios for a company and to comment on them. So this is just looking at the calculation of the ratios. And to do that, we're looking at the May 2016 exam, and it's the Financial Accounting 1B paper. And on that paper, question 2 was the question that looked at the ratios. So here's question 2. We're given 2 years, 2016 and 2015. We're given the results, the income statement for each year and the statement of financial position for each year. So what this means is the closing inventory in 2016 was 12,000 and at the end of 2015 was 23. The total assets at the end of 2016 were 272,700 and were 203,000 in 2015. So you're going to be asked to calculate ratios, and these are the 8 ratios you need to know. There's also marks going for discussion, but this screencast is just looking at the calculation of them, remembering them and calculating them. And a lot of them are pretty okay to remember, and we're going to just look at the most straightforward ones first. So your gross profit and net profit, very similar. You just got to remember that it's linked to sales. So your gross profit over your sales, net profit over sales, and multiply by 100. So that all of these 3 are percentages. So your answer should be given in percent. So here it is: gross profit over sales by 100, net profit over sales by 100. And that's the formula. So gross profit over sales, gross profit is 153,482 divided into sales over 230. And I'll just show you what that looks like in an answer. 153 over 230 multiplied by 100 gets 66, and the easy way to do this is have 2 columns, one for 2016, one for 2015, and then we just get the figure for 2015, 181.5 over 300, which came from here, gross profit 181.5 over 300. Next we were doing the net profit percentage, and it was net profit over sales, and the profit that we use here is your operating profit, your profit before interest and tax. Sometimes it's shortened to PBIT, profit before interest and tax. The easiest way to find it is find your interest and it's the profit above it, or else it's the profit after your normal expenses, your admin and distribution expenses. So here, find the interest, it's the profit figure above it. That's our profit before interest and before tax. So 82,182 over 230. Multiply by 100 to get 35, and next then it'll be 60,200 over 300, which I get from here. Here's the 62 divided into 300, multiply by 100. I'm going to return to this one. I'm just going to move on to the more easier ones: current ratios and asset test ratios. Look at liquidity, how easily a company can get its hands on cash quickly to pay its short-term liabilities. So what we're looking at is our current assets versus our current liabilities. How much bigger are our current assets compared to our current liabilities? And the answer for this is always 1 is to a number. So if our current assets were twice as big, it should be 2 is to 1. So the answer normally is given. So if our current assets were twice as big as our current liabilities, the answer would be 2 is to 1, which just means your current assets are twice as big. If our current assets were 4 times bigger, the answer would be 4 is to 1. If our current assets were smaller than our current liabilities, then the answer would be 0.5 is to 1. So once the current assets are smaller, the first number is going to be below 1. So I think I had shown it wrong in that sheet. So ignore that bit. It's always the question mark is to 1. So current assets over current liabilities. In 2016, current assets are 35,409. And current liabilities are 44. So just 35 over 44. So here's the 35,409 over 44,000. So divide, the current assets here are smaller than the current liabilities. And once you divide the top into the bottom, you get 0.8 is to 1. So it's just 35,409 divided by 44,000 gives you 0.8065, so 0.8 is fine to say is to 1. And then we look at the previous year. Current assets here were 58,840, current liabilities were 30, so straight away we can see the current assets are bigger than current liabilities in 2015. The company was more liquid, it had more cash than it generally needed, was in a better position than 2016. So 58 divided by 30, straight away it's going to be 1 point something is to 1. And it just works out 2 is to 1, or that might be 1.96 is to 1 would be the more exact answer. So 58,840 divided by 30,000. Next one is the asset test ratio, and that was your current assets minus your closing inventory over your current liability. So exactly the same one, the same figure on the bottom, 44 and 30 in this. The only thing that changes is we need to take away closing inventory. So 35,409 minus 12. And here it'll be 58,840 minus 23. And then put those figures over the current liabilities. And that's it there. And just remember, your answer should always be is to 1. 1.2 is to 1, or 0.5 is to 1 is in this instance. So these three ratios are to do with efficiency, which is looking at how efficient the company is at managing its working capital. Its working capital is largely made up of money owed to it from its customers, which are receivables, and then money that the company owes to its suppliers, which are payables, and then inventory, how much inventory or stock the company has on hand. So obviously a company will want to get paid quickly by its receivables, so you'd want that the amount of time receivables days is the amount of time it takes your customers to pay you, so you'd like that down as low as possible. A cash, if you sold your goods for cash, that would be 0 because there'd be no days due. If it took 1 week for your customers to pay you, your receivables days would be 7 days. If it took them a month, it would be 31 days if it was a 31-day month. Payables days, so obviously the quicker you get paid the better. Here this is how long it takes the company to pay its suppliers, so it's better for your cash flow if you can push that out a bit. So at least you should ideally get paid by your customers before you have to pay out your suppliers. Now you don't want to spend too long to pay your suppliers because you know it's bad for relationships with them. And inventory days looks at how long inventory is held before it's sold. And once again, the quicker you sell your inventory, the quicker you get cash in, and the less chance there is of inventory going bad. So the answer to all of these will be days. So it won't be percentages, it won't be something as to 1, it'll be a number of days, so 20 days, 30 days, 40 days, whatever. And most of the formula is given here, so you nearly you have 2/3 of the formula. So it's receivables, and if you see days, multiplied by 365 over something. Payables by 365 over something. Inventory by 365 over something. So all you've got to remember is the bit that gets divided underneath. So receivables is your customers, is to do with sales. And if you think even the alphabet, A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P, Q, R, S, R and S come after each other, or S comes after R in the alphabet. So receivables over sales by 365, that's the formula. So receivables in 2016, 18 over 230 multiplied by 365, and 2015, 34 over 300 multiplied by 365. And there is the working. And once again, all you do is go 18 divided by 230 multiplied by 365, and you get 28.56 or 28.6 days. And there was the previous year, 2015. So I said most of the formula is given to you in this. So payables by 365 over something. Inventory days, the same, inventory by 365 over something. So it's the something we've got to remember. And if you remember that sales, it relates to receivables, payables and inventory are to do with your purchases, your cost of sales. So the two of these are over your cost of sales. So payables by 365 over cost of sales, inventory by 365 over cost of sales. So they're quite similar. And then just show the working. Payables is 32,000. Cost of sales was 76,518. 12,000 over 76,518 gives you multiply by 365 gives you 57.12. 12,000 multiply by 365 and divided by 76,518 gives 57.24 there, so 57.2. So you can just round it down to one decimal place in all of these if you wish, or you can go to two decimal places. And there was 2015. And there, sorry, that was payables, 32 there. That was inventory. And here was payables, 32 over 76. And we got 152 days. So the figures for inventory, I'll just get them. Inventory, 12,000 over 76 by 365. 23,000 over 118. 12 over 76, 23 over 118,500. And that's the workings for them. So the only one not done is the return on capital employed, which is net profit over debt plus equity. So it's the same net profit as we used for the one above, which is your profit before interest and tax. And then capital employed is the long-term funds invested in a company or a business. And the long-term funds are the equity invested by its shareholders and any long-term debt, the non-current liabilities. So debt is non-current liabilities and equity is the equity. So we just find them from the question. Here's our interest, 18. The profit before that, 82,182. So that's our PBIT line there. That's what goes on top. And below is our debt and equity. So we find them in our statement of financial position. Here's our equity. The total of these two, 78,700. And your non-current liabilities is your debt. The 150 there is your D. So this line is your debt. And this line is your equity. So 78.7 plus 150 is our debt plus equity, or our capital employed in 2016. So 150 and 78 gives 228,700. So that's the formula for 2016. The profit for interest and tax over the 228 multiplied by 100. And the same in 2015. That's our debt, that's our equity, it adds up to 173, and then your PBIT, your profit before interest and tax over that, and you get a percentage. And that's the calculation of the 8 ratios. So to get the marks in this question, you need to know the 8 ratios. You need to be able to calculate them for 2 years, and once you've that done, that's 20 marks. You know, and then later on you can discuss them. That'll be addressed in a separate screencast. So good luck with that, and the best revision you can do is look at this question, look at previous exam papers, and do those questions as well.